Joining us right now is Amy Wu Silverman. She is head of derivative strategy at RBC Capital Markets. Also, Aditya Bave, who is senior U.S. economist at Bank of America. And Aditya, why don't we just start with you, just looking at what's happening. This is a big week for data. What are you expecting with the jobs report? What other numbers are you watching? What should we be really paying attention to?
Absolutely. Good morning. Thank you for having me. The two big readings this week, I think, will be number one, by far, the jobs report. We're looking for 175,000 on non-farm payrolls, 3.5% unemployment rate, so that's flat, and 0.3% wage inflation. In terms of jobs, we think there are risks to the downside given the shutdown of Yellow that led to about 30,000 in job losses. I think the risks are that we get a slightly softer number, which would be welcome for the Fed, right? And then on Thursday, we get PCE inflation. We're looking for a 0.3 on the core. That's a little bit above consensus. So that could be a little bit more concerning from the Fed's perspective. We obviously, with the PCE report, also get income and spending. And there we look for spending to significantly outpace income. We saw that in retail sales for July. We saw that in utility spending. And so, we think that the saving rate could fall quite significantly in July.
Amy, what is the options market telling you, just in terms of what they're anticipating, what the realm of volatility is for these numbers this week?
So look, Becky, the options market has been remarkably low and remarkably sanguine. I think that part of this is just due to seasonality. Obviously, the numbers coming this week are critical and also just depends on how they fuel into what happens a few weeks from now. I will point to one thing, which is, look, in the options market, we've had a lot of exuberant sentiment, both on the index level as well as on specific mega cap tech stocks. And obviously, those could be harmed, depending on what the rate story is from here. And what I will tell you is that exuberance, that demand for those call options has been waning. So, I would point to kind of the lack of positive sentiment that we saw a few months ago heading into these numbers, but not necessarily yet the full rising of bearish sentiment.
How much of that is a reflection of the economy and what we think the Fed's going to be doing? How much do you think that is a reflection of what we've run through already, the exuberance in the technology front? Do we think AI has more room to run with this?
If you look to the tea leaves of the options market, it would say no, that momentum is starting to wane. And, we've been joking a few months ago, people couldn't wait to jump into the pool. So you get this positive momentum, be getting more momentum. And I think positioning wise, arguably everyone is in the pool. So the question is now, what do you do from here at these levels? And I would tell you that the sentiment has turned not to this overbuying of call options, but now more towards should we be hedging as we close into the end of the year?
What's the answer?
So I think that, look, I think from a valuation perspective, it's something that our own research analysts have argued about, that we're probably nearing a point where at least there's limited upside into the market, not necessarily full downside. But when you look to the derivatives market, I think some of the best tactical trades right now still remain selling upside, given to where we see upside targets are, and then potentially using that to fund downside.
Aditya, what is the underlying pace of this economy right now? I mean, you mentioned we're going to have a strong showing probably in consumer spending. We're in a bit of a hot streak in terms of GDP indicators for this quarter, but we have a decelerating jobs market. Everyone's waiting for the lagged effect of those Fed rate hikes we got over the last year and a half. Where are we headed to? Is the soft landing about going back to 2% growth, or are we still at risk of something worse?
It looks like for this year, at least, we could print at least 2% on growth. I mean, if you think about it relative to 3 months ago, it's pretty remarkable. As of a few months ago, first quarter GDP printed around 1%. We were looking for 1% on the second quarter, and instead, the first quarter got revised up to 2%, and the second quarter came in at 2.4%. And now for the third quarter, we are tracking 2.8%. I know there's other measures from the Atlanta Fed that are giving you a significantly higher number. So if anything, it looks like spending has accelerated a little bit. And yes, the labor market has lost momentum, that is natural as you get closer to peak employment. But I think the point is that we're still running at around double what would be the break-even pace, given the speed of population growth. And so we're still putting downward pressure rather than upward pressure on the unemployment rate.
How do you factor in China and the slowdown they've seen? Is that something that's going to be contagious to us?
Right. So the U.S. is typically well insulated from shocks abroad. The U.S. doesn't really import recessions. That's what history tells us. And with China, we've looked at exposure to direct demand. We've looked at exposure in terms of exports to China. Both of those are around, 60, 70 basis points of GDP. So even a large shock coming out of China, and even if that were to propagate to the rest of the world, I would not imagine it would take more than one tenth of a percentage point off of U.S. GDP.